Hello, I'm Hayley Atkin, and I'm joined today by Olivier Marciot, who is Portfolio Manager in our multi-asset team. Olivier, 2017 has been a strong year in terms of multi-asset returns. What have been the key takeaways in your team's view?
Last year has been quite extraordinary in terms of asset returns. This was mainly due to the unusual combination of strong growth, tepid inflation pressures, and actually very high levels of monetary accommodation. The global economic environment has rarely been so synchronized. We've continued to see a strengthening growth last year, evolving into above potential levels in developed markets, and with a very strong catch-up from emerging countries. The surprise actually came from the inflation front, where inflation measures were more tepid than expected, and they could have been rising more firmly than they actually did. On top of that, market stress remained extremely low in the absence of major political or geopolitical events. Those put together actually created a very supportive environment for financial assets and created the kind of returns we've seen in 2017. But the very important part, in our opinion, has been the way central banks have been communicating around the turn they took in their respective monetary policies. It's been actually quite spectacular to see how well, for the most part, they've been able to communicate around the evolution of their monetary policy changes during official meetings, but even more so in between those meetings to help prepare and guide the markets into the next adjustments that they needed to make. So we are really convinced that they've been acting like that to keep financial volatility grounded as long as they could afford to, but that may not last forever.
And which key themes do you think are likely to be influencers of performance this year?
We believe that there will be two main factors that will make things quite different this year. Monetary policy will be normalized more rapidly than what markets currently expect. And the main reason for that will be a surge in inflation pressures from currently very low levels. The risk for central banks to fall behind the curve was very limited thanks to what the Fed has called the inflation mystery. It enabled them to unwind monetary accommodation very slowly and gradually up until now. However, we think the risk will substantially increase in the quarters to come as we expect to see a stronger inflationary context. We believe that the return of inflation will come from various elements. First and foremost, economic growth will continue to be strong again next year. Then, we will finally start seeing the effects of the rise in input prices for goods inflation, which represent a large part of CPI indices and have been lagging service inflation for the last few years. Finally, tensions in the labor market will increase wage pressures. All these components put together will help bring price stability on the front scene next year. This will force central banks to accelerate their monetary normalization process by reducing asset purchases broadly and raise interest rates across the board to bring them closer to their actual state of the economy and therefore more in line with their natural fundamental levels. The lack of inflation was the last rampart that prevented central banks to fall behind the curve, and it may well be about to disappear. 2017 acted as a transition year on that respect, and in our opinion, we will need to prepare for more in 2018.
With this in mind, how are you positioning your portfolios for the coming months?
One of the key elements in the way we run multi-asset portfolios at Unigestion is what we call dynamic risk management. The objective is to constantly assess the risks in the market and adjust portfolios accordingly to protect investors against potential corrections or drawdowns. Given our views for the year to come, we are naturally and obviously underweight sovereign bonds for the moment, as they will be the first to suffer from the acceleration of monetary normalization and by the repricing of the inflation premium. We have a strong conviction as well on inflation-related assets, so we have an increased exposure to both commodities, as they will contribute directly and indirectly to make inflation happen, and long inflation break-evens, as they will benefit from the repricing of inflation expectations. We are also constructive on growth-related assets, as the macroeconomic context is still sound and improving. Our preference goes currently to equities over credit, as we think there is still room to go for companies' profit to enjoy the growth ride, whereas the current level of credit spreads and tightening liquidity conditions does not make us feel comfortable holding larger exposures to credit at the moment. Finally, we don't think we'll see this year the same kind of returns that we've had last year. So we have started adding layers of hedges on top of our strategies to help cushion investors' portfolios against potential corrections that may be ahead of us and smooth performances as much as possible.
Thank you, Olivier. For more information, please visit our website at www.unigestion.com.